Understanding capital gains tax and capital losses is essential for investors and individuals who engage in buying and selling assets such as stocks, bonds, real estate, and other investments. Here's a comprehensive overview. Capital gains. Capital gains refer to the profit realized from the sale of a capital asset, such as stocks, bonds, real estate, or collectibles. The capital gain is calculated by subtracting the purchase price, cost basis, of the asset from the selling price. Capital gains are categorized as either short-term or long-term based on the holding period of the asset. Assets held for 1 year or less are considered short-term, while those held for more than 1 year are considered long-term. Capital gains tax. Capital gains tax is a tax imposed on the profit earned from the sale of capital assets. The tax rate applied to capital gains depends on the holding period of the asset and the individual's income tax bracket. Short-term capital gains are typically taxed at ordinary income tax rates, which can range from 10% to 37% in the United States, while long-term capital gains are taxed at lower rates, generally ranging from 0% to 20% for most taxpayers. Capital losses occur when the selling price of a capital asset is lower than its purchase price. Capital losses can be used to offset capital gains realized in the same tax year, reducing the overall tax liability. If capital losses exceed capital gains, the excess losses can be used to offset other types of income, such as wages, salaries, or investment income, up to certain limits. Net capital gain or loss. The net capital gain or loss is calculated by subtracting total capital losses from total capital gains. If the result is a positive number, it represents a net capital gain, which may be subject to capital gains tax. If the result is a negative number, it represents a net capital loss, which can be used to offset capital gains and other income. Unused capital losses can be carried forward to future tax years to offset capital gains and other income in those years. Capital loss carryover rules vary by jurisdiction but generally allow taxpayers to carry forward losses indefinitely until fully utilized. Wash-sale rule. The wash-sale rule prohibits taxpayers from claiming a tax deduction for a security sold in a wash sale, which occurs when the taxpayer sells a security at a loss and repurchases the same or substantially identical security within 30 days before or after the sale. Violation of the wash-sale rule results in the disallowance of the loss for tax purposes. Tax loss harvesting. Tax loss harvesting is a strategy used by investors to intentionally sell investments at a loss to realize capital losses for tax purposes. By strategically harvesting losses, investors can offset capital gains and reduce their overall tax liability. Seeking professional advice. Given the complexity of capital gains tax rules and regulations, investors should consult with tax advisors, accountants, or financial planners to develop tax-efficient investment strategies and ensure compliance with tax laws. Understanding capital gains tax and capital losses is essential for effective tax planning and investment management. By leveraging capital losses to offset capital gains and employing tax-efficient investment strategies, investors can minimize their tax liabilities and optimize their after-tax investment returns.